Every entrepreneur wants to build wealth. You start a business to escape limits, not to be crushed by them. But there is a silent threat to your success that most business owners never fully understand: taxes. Not taxes themselves, but the failure to take full advantage of what the system legally offers. Because let us be honest, most entrepreneurs overpay. Not because they are careless, not because they are dishonest, but because they simply do not know. The tax code is long, confusing, and ever-changing, and buried inside it are legal tools designed to reward business activity. Tools you can use to lower your taxable income, protect your profits, and accelerate your growth. Yet every year, thousands of entrepreneurs miss the same 5 deductions. The same 5 opportunities to keep more of what they earn. The same 5 secrets that the wealthy have used for decades. You do not need to break the rules to win the game. You just need to know them. And if you master these 5 deductions, if you use them intentionally, you will not just survive tax season. You will turn taxes into a weapon for growth. Number 1. The home office deduction, the most misunderstood and most ignored tax deduction for entrepreneurs is the home office. It sounds small. It sounds risky. Some people even think claiming it increases your chances of getting audited. But when done correctly, the home office deduction is one of the most powerful and underused tools available to small business owners. Here is how it works. If you use a part of your home regularly and exclusively for business, you can deduct a portion of your household expenses: mortgage interest, rent, utilities, insurance, property taxes, even repairs and maintenance. That means the space where you write, think, email, call, plan, or sell. It is not just a room. It is a financial asset. Yet most entrepreneurs ignore it. They assume it is not worth the hassle. Or they use a room for both work and personal use, which disqualifies the deduction. But the key is the phrase, regular and exclusive. If you can clearly define the space and its use, you unlock a proportional share of your living costs as a legitimate business expense. For example, if your office is 10% of your home's square footage, 10% of your qualifying household expenses become tax deductible. That can mean thousands of dollars saved every year. And even if you do not want to calculate it manually, the IRS offers a simplified option: $5 per square foot, up to 300 square feet. Smart entrepreneurs treat their homes strategically. They know that the environment where you build your business should also protect your income. The home office deduction is not a loophole. It is a gift if you use it wisely. Number 2. Business use of your vehicle. You probably drive for your business all the time: meetings, deliveries, supply runs, events, bank visits. But are you tracking that mileage? Are you recording those trips? Or are you leaving thousands of dollars unclaimed every year? Most entrepreneurs casually mix personal and business driving. They assume they will remember later. They assume they will calculate something close enough at tax time. But that close enough mindset is exactly why they miss out. Here is the truth. The IRS offers 2 ways to deduct vehicle expenses: standard mileage or actual expense. And both require documentation. If you take the standard mileage route, you simply multiply your business miles by the IRS rate, which changes yearly. But you still need a log. If you choose the actual expense method, you can deduct a portion of fuel, insurance, maintenance, lease payments, registration, and even depreciation. But again, you need clear records. Many entrepreneurs do not realize just how quickly mileage adds up. A few short trips a day can translate into over 10,000 business miles per year. Multiply that by the standard rate, and you are looking at serious savings. The fix is simple: use a mileage tracking app. Record every business trip. Be disciplined about separating personal and business use. And review your method with a CPA to choose what saves you the most. Your car is more than transportation. It is a moving deduction, if you treat it like one. Number 3. Health insurance and medical expenses. Entrepreneurs do not have the luxury of employer-sponsored health care. You are your own provider, and that reality often leads to expensive premiums, high deductibles, and out-of-pocket medical costs. But what most business owners do not realize is that many of those costs are tax deductible if you structure them properly. If you are self-employed and not eligible for an employer plan, you can deduct 100% of your health insurance premiums from your income, including dental and long long-term care insurance. That applies to policies for yourself, your spouse, and your dependents. It is not an itemized deduction. It comes off your adjusted gross income, which means bigger savings. Now here is where it gets better. If your business is structured as an S-corp and you pay yourself a salary, you can have your company reimburse you for premiums and still deduct them on your personal return as long as they are reported as income. It is all about structuring the flow correctly. Beyond premiums, you can also deduct medical expenses if they exceed a certain percentage of your income. But even better, you can open a health savings account if you have a high deductible plan. Contributions to an HSA are tax deductible, grow tax free, and can be withdrawn tax free for qualified medical expenses. Yet most entrepreneurs do none of this. They treat medical costs as personal burdens, not business opportunities. But the tax code rewards planning. If you treat healthcare like an investment and organize it through your business, you reduce risk and build long-term efficiency. Number 4, meals and entertainment. The right way, many business owners assume that meals and entertainment are either too minor to track or too risky to claim. That is why they pay out of pocket and forget to record them. But when used correctly, this category can save a surprising amount. Without raising any red flags, the IRS allows deductions for business-related meals, typically 50% of the cost, when they are directly tied to business activities. That means meals with clients, vendors, partners, or employees during meetings or travel. And for certain events or types of meals, you may even be able to deduct 100%, such as company parties or meals provided for the convenience of the employer. But here is the catch: documentation matters. You need to record the date, amount, location, people involved, and business purpose. A 100 dinner with a vague memory of talking business will not cut it. But a properly logged meal with a client where strategy or negotiation occurred is valid and protected. The same goes for travel meals. If you are away from your tax home for business, meals are deductible. If you bring an employee along, both meals can be deducted under the same rules. Track every meal, log every purpose, and watch how your everyday actions, if tied to real business activity, can reduce your tax bill while deepening your relationships. Number 5, retirement contributions through your business. This is the hidden gem almost no new entrepreneur uses, and the one that separates the good from the wealthy. Business owners have access to some of the most powerful retirement contribution options in the entire tax system, and most are not using them. If you are self-employed or own your own company, you can open a solo 401k, SCP IRA, or even a defined benefit plan, all of which allow for massive tax-deferred contributions far beyond what regular employees can do. For example, with a solo 401, you can contribute as both an employee and an employer, up to $69,000 per year depending on your income. A SEP IRA lets you contribute up to 25% of your income. And for high-income earners, a defined benefit plan can allow 6-figure contributions every year, completely tax-deductible. These contributions lower your taxable income now while growing your wealth for the future. It is the perfect blend of immediate savings and long-term security. But most entrepreneurs do not know these options exist, or they assume they are only for older or richer business owners. That could not be more wrong. The earlier you start, the more you benefit, and the setup is not as complex as it seems, especially with a CPA or financial advisor guiding you. The key is this: you are the employer now. You control the retirement plan, you control the structure, and the tax code is begging you to take advantage of that power. The rest will overpay, year after year, because they were too busy to plan, too uncertain to ask, too distracted to track, and in the end, they will wonder why their business felt successful but never made them rich. Do not be that entrepreneur. Be the one who acts, the one who organizes, the one who studies the game and plays it well, because the IRS is not the enemy, but ignorance. That is. And if you are ready to go one level deeper into the hidden systems the wealthy use to structure their businesses, investments, and time, watch the next video. You will not look at taxes, income, or ownership the same way again.